Good morning and welcome to the Killik podcast for Friday, the 8th of April. So in this podcast, we're just going to have a quick look at how the macroeconomic picture is developing and how we're dealing with that and the challenges it presents in the portfolios. So the Fed minutes this week highlighted that 8 of the members of the 15 see downside risk to growth in the US and 11 see downside risk to the inflation target. Here we've got the Atlanta Fed US GDP forecast, and as you can see, that has deteriorated pretty aggressively. So we're looking at 0.5% growth for Q1. At the same time, we've seen the S&P go to almost new highs. So that sort of disconnect is worth investigating. Clearly, the strength of the market has been due to an easing of financial conditions. That's a weakening of the dollar, a sort of normalization of credit spreads. But we still see a weaker global backdrop coming through in Q1 and into Q2. We see higher credit defaults. We see ongoing earnings recessions in certain industries. And we see a lower US domestic growth because of the impact of those earnings recessions in certain industries. So combined, that makes a fairly anemic growth total for the US, the major economy, global economy. So low growth, static rates, this reinforces the growth bias in portfolios. So we're looking for areas where we have strong growth rates that we can hang portfolio investments on. So we've seen visible acceleration in certain areas justifying premium valuations. And the first one is in the online advertising market. So we're seeing Alphabet, which is the new name for Google, and Facebook see very attractive growth trends and margin trends. So here you can see the share prices have been very solid throughout this sort of difficult period for markets. And this is because of the very fast growth rates coming through in mobile search advertising. So we're seeing more and more time spent online, and 70% of that online time is spent on mobile due to the larger screens of phones, and that's driving more advertisers to advertise on mobile platforms, and the advertisers are getting better return on investments because they're able to target their consumers more effectively. We're also seeing within that, we're seeing video being a very fast growth area. So 30% of time online is now spent watching videos, and the chief provision of those videos is through YouTube and through Facebook. So YouTube US video viewing grew at 65% in February, and 70% of this market is split between Google and Facebook on a global basis. So that's two companies accounting for such a huge market. Overall, you see the 17% CAGR growth rate coming through in digital advertising, and that's in a period where general economic activity is pretty lackluster. Equally, Visa and the payments market is something that we have confidence in, and that's something we're adding to in portfolios along with Alphabet and Facebook. So here you've got the secular tailwind of a CAGR of 9%, helped by consumer spending growing, and also by a shift from cash to electronic payments. We feel that Visa, if you look at the total return, which is the earnings growth, the buyback, and the dividend, can deliver around mid-teens, 15% for the next 3 or 4 years. And therefore, the valuation of these stocks is not expensive because they trade around 20 times earnings, and you're getting 20% earnings growth in total. The ability of these businesses to continue to deliver that if we go into a slightly recessionary downturn, we think is better than the market appreciates. So if you look at consumer growth, the absolute declines in consumer growth to negative levels have only really occurred in very, very severe financial recessions, i.e. 2009-10. We don't see that in the current environment. And we feel that the way that the market is disrupting is actually in favor of these businesses, these payment networks. So as we said before, Apple Pay, PayPal Online, and other disruptors have chosen to partner with Visa in order to deliver their service, thereby expanding their marketplace. Next week we've got results for Q2 starting, and they start as ever with the financials. Clearly around financials, because of this slowing GDP growth rate, there are concerns, and the stocks have been selling off in this kind of market. So the positives are, particularly with respect to Wells Fargo, solid jobs growth, wage inflation, house price growth. They're still finding profitable client acquisitions. The negatives are this flat yield curve that we've talked about, energy defaults coming through, concerns in the market about that, and concerns over negative rates and that impact on margins. We feel that the valuations continue to be very supportive for these stocks. So Wells Fargo has an equity yield of around 10%. They're paying around 3.4% of that out in dividend. And if you look at that dividend yield against 10-year bond, as you can see here, we think that's a fairly reliable yield, and it stacks very attractively against government bonds. So looking at next week, as I said, we've got Tesco's on Wednesday from the Killik stocks, then we've got Wells Fargo on Thursday. That's it from me. Thanks for listening. Have a good weekend.